Hello and welcome, dear investors. Hi to everyone around the world. We are streaming to many platforms, both on YouTube and on Facebook. I'm here with Chad from the United States. I'm Torsten. I'm in Germany located, and Chad is located in the United States, in Seattle to be exact. We are talking about dividend stocks this time, and thank you very much for all the input you gave us. We will talk, or we will present 6 dividend stocks, Chad 3 and me 3. It will be safe dividend stocks. It will be dividend stocks from non-cyclical sector, and this is why dividend stocks or these stocks or this kind of stocks are very popular for many dividend investors because we live in uncertain times, especially regarding the corona pandemic. And you probably know, independent where you are living, that, for example, in the United States, the situation seems a little bit, or is getting maybe close to be out of control regarding corona. And because Chad is living in the United States, I asked him yesterday if he's willing to give us a little impression of what's happening right now in the United States. So, Chad, hi.
Hello, Torsten.
Hi. Are you willing to give us your subjective perception about what's happening in the United States?
I can try. One slight disadvantage that I have is we don't have TV. We literally don't have any connection to the mainstream news. All of my news comes from online sources, but I can show some of those and I can give my impressions on that. So it's a really important topic right now. The United States is going through what people are calling the second wave, but let me bring up my screen and we can see what that actually looks like. Because, okay, I need to change the source. Okay, I'm going to stop that, share screen again, and I want an application window. Let's go with this one. There we go. So this is Worldometer, and where am I? There it is. So here's the global perspective of how the number of daily new cases are going.
Can you increase it a little bit? Yeah, exactly.
Okay. So this is daily deaths, tracking all the way to the beginning of the year. This is daily new cases since they started tracking the data. And this is the entire world. Let me bring up just the United States. You can see the total number of cases, total new cases yesterday, total deaths. Here's new deaths that were reported just yesterday. Let's zoom in a little bit. So the United States alone has 4.3 million cases with about 2 million recovered. And if you go down to the graph, it's people are calling this the second wave, but I want to bring up another version of this screen that shows another country. I don't know. Let's pick something at random like Germany. Let's bring up Germany if I can find it down here on the list, because you guys have been doing so well comparatively. There. So here's the graph for Germany in parallel with timeline with the cases in the United States. And this is what I call a wave and then a long tail. Those are terms from statistics. And so we had a big spike and then things got under control and now your number of new cases is staying at a steady rate. It is a virus. It wants to spread all over the place, but I would call this under control. But if you look at the United States, it never came down. It never really came down. The number of new cases peaked at 35, 34,000, something like that. Other than weekends, but the lowest it got was around 20,000 daily cases per day. It didn't go down to a controllable manner again. So people in the media that I'm reading about are calling this the second wave. That's not how I see it. I see this as part of the first wave, and there's another term for that is not wave. It's called tsunami. And I think that's what the United States is dealing with. We're dealing with a tsunami of cases that is not going to go down anytime soon to a reasonable level, like Germany did, like Italy did, like China did, the source of the entire thing.
And I have a question, Chad, about the implications for us investors, because United States are the most important single country in the world from an economic point of view for investors. And what implications does this have if this tsunami continues, in your point of view, in the United States, if Corona runs havoc? Do you see a stock market crash? That's the mother of all questions, probably.
Yeah, it's the mother of all questions. I do see it going down, but one of the things that I've been noticing about the markets is they're very predictive. So if you've got analysts that are looking at all of this data. We live in the information age. We live in a world of data that is constantly flooding in. We know what these numbers are. We have some governments that are trying to hide what the numbers are from the public by redirecting the information from hospitals into, I don't know, what you'd call it cold storage, where the media can't get access to the numbers. The United States is one of those, thanks to the newest rule. But if you look at the economic indicators, we've seen the stock market go crazy. There's a number of different reasons for that. I think primarily it's because so many people were stuck at home that they didn't have anything else to do except look online, and then they started seeing, ways to get rich in the stock market. That's the ultimate American dream, is to make one magical decision and suddenly all of your problems are completely solved forever.
I don't know about the importance of the private investors, even in the United States, where stocks are much more popular than in Germany compared to institutional investors. But one thing is true. For example, in Germany, while people were forced to stay at home during the Corona peak, the brokers were really one of the rare sections or industries which profited highly. So there were a lot of new accounts, brokerage accounts, which opened. And my contacts, because I'm affiliated with some brokers, verified this. Anyway, I think we have already seen some effects of the coronavirus. The most important one was the stock market crash, starting in the second half of February till the second half of March. Then we got the recovery, phase 2 of the Corona age, which led to Nasdaq and tech stocks. They boomed. There were really high capital gains to do. And then we had this retail sector and the tourism or other sectors which were really which still lose ground up till today. especially in tourism. And many dividend investors are unsure what to do right now because they never heavily invested in tech stocks, because very often tech stocks, especially in the software industry, they don't pay high dividends, or they don't pay dividends at all. That's why many dividend investors aren't happy with their performance right now. But that's one thing. And the second thing is even worse. Some dividend investors, especially those investing in high yield stocks, have lost a lot of capital losses right now, and even dividend cuts. And I think this is why dividend investors, and why you also, the audience, came up with, we want reliable dividend stocks, even in Corona times. And that's why you asked about uncyclical dividend stocks or non-cyclical dividend stocks. And Chad and me, we both selected 3 dividend stocks, which should be very robust even in Corona times. And Chad, maybe you present your 3 stocks first, and then I will present mine. Is it okay?
Yeah, that's great. Before we do that, and I'm sorry about all the delays a little bit with my screens, because I'm still getting used to the interface here. But I want to bring up a comparison between the unemployment rate in the United States and how it has changed thanks to the coronavirus. This is unemployment going back 10 years, and let's take it back 25 years. So the previous peak in unemployment was here in 2010. That was at the peak of unemployment thanks to the Great Recession, when the banks failed us all. This was the massive spike in the middle of March and April, and it's coming back down again. If we compare that with Germany, let's take it to the same time frame. So Germany did not have as much of a spike, but you've been coming down from something else that happened in the early 2000s. But look at this spike here compared to the United States. There's no comparison. But it's not really a collapse. It's going to be a change. I think looking at consumer staples, consumer non-discretionary, grocery stores, and other things, that is a really important topic to look at, because these are things that everybody needs all the time, and they're constantly shopping for them. How they get them is changing. Instead of going to stores with a whole bunch of people, you're going maybe once a week instead of every couple days. At least here in the United States, that has been a norm. Or we are asking the grocery store to have the bags ready for us to pick up as we drive by. That way we don't even have to get out of the car. What we're seeing is a massive reduction in human interaction thanks to the coronavirus scare. And it's not just a scare, it's a real thing. But those kinds of changes are really important. But I think the consumer staples sector is going to do fine. People still need groceries. People still need all of these things that they've been, that we need to survive. But I wanted to show the unemployment rate just as a follow-up on the coronavirus, because this was the result. Let me bring that back. This spike was the result of everything in the United States shutting down. It is starting to come back down, but this data lags a little bit. If we had more time, I could show a lot more data. This Trading Economics website is fantastic for showing lots and lots of data in really good ways. But I wanted to show that. Now let's go into the consumer discretionary. Let's see. Can we? Nope. Okay. Let's grab this and move it into where we can see it. Okay, so I'm going to talk about the top couple stocks on my TGI ranking list, which I will also bring over. I've narrowed it down just to consumer staples, and I want to talk about the top couple stocks on my list. First off is Costco Wholesale.
Can you zoom in a little bit?
Let's see.
And Chad, your list is publicly available.
Yes,
And
this list is in public. How's that? Is that easier to see? Okay. So the top stock here is Costco Wholesale. The dividend yield is 0.86% right now. I've heard a lot of people, and you mentioned it yourself earlier, people look at a decent dividend yield as a starting point. I don't, because what I see in a stock yield is a snapshot moment in time. What I really want to see is growth, because if a stock like Costco is paying 0.86 now, what is it going to pay in 3 years? What is it going to pay in 5, 10, or longer? Okay, so to look at that, let me bring it up on Seeking Alpha, because what I want to see is the change in yield on cost. So again, right now we're at 0.86, but if you had bought Costco 5 years ago, this is a 5-year timeline, you'd be getting 2.01, which is pretty much exactly what the S&P 500 pays overall. It's the overall average. If we take it back 10 years, you're getting 5.78, which is really nice. If we take it back 20 years, we're seeing 10.17. And if you'd bought it at the very beginning, well, okay. This is 1995 when they first came on the market. They were some pretty low prices at this point. People who bought in 1995 here are getting 50% yield on cost. If you're looking to invest long-term, don't just look at today. You're investing for the future. So this is Costco. Let's look at another one. Keurig Dr. Pepper. Let's bring up the same thing. So right now, the dividend yield is 1.98, which is not bad. But if you take it back again, looking at yield on cost, back 10 years, you're getting about 10%. And that spiked up to 30% if you'd bought it in 2009. The stocks are growing. Let's look at dividend growth on these two. So this is the kind of growth that I like to see. They had a dip, but they're coming back. Let's look at dividend history. Whoa, that's a special. Might be easier to see this on your website.
Chad, I have a question.
Yeah.
I agree with you about the importance of dividend growth, but you're looking only into the past, or do you also look into the future? For example, looking at estimates, especially. And do you also look at underlying earnings and so on? For example, the payout ratio is a classic. So you don't see in the chart you've just shown us, you don't see the evolution of the payout ratio. It might be that the management increased the payout ratio to keep investors happy, but maybe that anytime soon the top is reached and they can't increase dividends anymore. So a little bit more. A little bit deeper fundamental analysis. Are you doing this too?
A little bit. The thing is, my total growth investing ranking list uses 3 indicators and 3 ways that I rank stocks. The first one is dividend growth. The second one is price growth. And the third one is payout ratio. So for dividend growth and price growth, I want that growth to be as high as possible, because that indicates to me that a stock is doing well. If a dividend growth number is really high, it means that the company is making profit. It means that they're doing well.
Mm-hmm.
If a company's price performance goes up, it means that those indicators, those fundamental indicators that you're talking about, are attractive enough for investors, both institutional and retail investors, that they think even at this price, even at a high price right now, let's look at what is Costco at right now? Costco's at 325. Okay.
Mm-hmm.
But if you look at price, and let's go to the momentum tab, let's go all the way down here. All right. So they've been peaked out up here in the 320s for quite a while, in around 300. What institutional investors are doing is they're looking at this price, then they are looking at all of those fundamental indicators, and they are realizing even if they buy it at 325, they're still going to be making money going forward. So that's why they're willing to buy.
Okay.
I don't use a lot of those fundamental indicators in my rankings because I know that the professional investors are. And it's basically like a shortcut. Also, when I started this, I wasn't super familiar with a lot of those indicators, and I'm still on the learning curve.
We can look at Costco later on dividend stocks cash, but
Right.
I think I interrupted you. There's still a third stock.
The next one I kind of want to look at is Kroger. It's
Exactly.
ranked at 104 on my list. Let's bring up Kroger. So Kroger is a grocery store company in the United States. They own a whole bunch of different brands in terms of the signage on the stores themselves. And let's see, how have they been doing? They do beat the S&P over 10 years. Looks like they had a little bit of a dip. Let's take a look at that. So here's 5 years, 10 years. So they spiked in 2015, 2016, and they've been coming down, but total return is pretty steady, and they are keeping up and beating the S&P right now. As far as dividend growth, as soon as it loads, okay, here's dividend history, and you can see a nice steady increase in the dividend payments. They've had a stock split, but if we take it out, look at that. So this is the kind of growth that every investor really likes to see. And it's all above 10%. 1 year, 5 and 10, 1, 3, 5, and 10 years are all above 10%.
You picked 3 interesting stocks because at least here in Germany, they are not. It's not the most popular stocks you told us about. Popular stocks would have been, don't know, Procter and Gamble and such kinds of stocks. This stuff. I think we can look on dividend stocks cash maybe, and we can analyze the stocks you just mentioned, except one. Huh? I haven't it on dividend stocks cash, but the other 2 we can have a look on them on dividend stocks cash.
So share your screen and let's see what that looks like.
So it's up to me now. I need to share my screen, okay?
Right. And I'm also looking at the comments. We're getting a lot of comments from all over the place.
Thanks for every comment.
Absolutely.
So before going to give me the whole screen, Chad, to make it even, yeah, exactly. And now give me the symbol of Costco.
COST.
Here it is. Ranking of 95. That's
Nice.
already looks nice. And here are the special dividends. I think you mentioned special dividends. The first thing I'm looking at, I'm changing the layout. The first thing I'm looking at when analyzing stocks is on the company level, revenues and margins. and they are both convincing. Really, also very stable margins, very low margins, below 3%, up to 3%, between 2.5% and 3.5%, something like that. But I think it's normal. In the retail industry, it's normal having margins like that. It's not important. Also, there are some investors who think that low margins are a bad sign by itself, but that's not true. It always depends on the industry where the stock is. Then you could try to compare Costco with other stocks and looking at their margins. If they are higher, it may be a sign that they are working more efficiently. You could do this, but just regarding the margins isolated on a company level, it's not a bad sign by itself if the margins are low. But it's a good sign, contrary by itself, if margins are stable like that. That's very good. And we have here starting in 2000, and margins are really stable. And then we have this revenue increase. And this is also a very nice revenue increase for 20 years. And the estimates are optimistic too, though it looks to be a very safe stock. Yeah, that's true. And regarding the dividends, here we have the special dividends. And because this stock, the management always decides to pay special dividends each 2 years. It looks 2013, 2015, 2017. That's a little bit, makes it a little bit difficult to analyze because of the scaling. But right now the dividend yield is rather low, huh, Chad? 0.8%.
Yeah, it is.
You are waiting for the next special dividend?
I don't actually count special dividends in my calculations. I think they're a special treat, but I don't depend on them for my revenue. They're
Okay.
if you look at just the regular dividends, then those are growing just fine.
Yes, yeah. I see. We started with about 40 US cent around 2005 for a whole year, and right now they are more than 5 times higher. But still, the dividend yield is very low. But again, that's not a bad sign by itself. Low yield or low margins are not a bad sign by themselves. Why do we have low dividend yield? Because the stock price went up, and if we change to logarithmic, then we see even a little bit better that we had, with the exception of the financial crisis and in 2002, very stable capital gains in the long run. With Costco, we got an average annual return, capital gains and dividends included, without reinvestment, of 12.6% starting in 2000. So for a boring retail stock, that's not bad, huh? 12.6%. So I agree that this is so far it was a great stock, and it looks to be a nice stock. What matters, of course, is valuation. So we say first, looks nice. This stock looks nice. I would like to own a little share of this company because it looks to be a quality company, high quality company even, but at any cost, and maybe not. So is easy to evaluate these stocks, maybe not using the cash flows because they're a little bumpy here at the end, but regarding both estimates, adjusted and reported estimates. So just let's give a little look about the valuation, and then I use really this big period here, fair value, and then you see the dilemma where we found a nice stock, but this nice stock looks to be aggressively overvalued right now.
Yes, it
Fair
is.
value between 200 and 212 US dollar, based on the estimate of the current business year, which is over soon. They have business year ending in August, so they still have 1 month open. it should be very close to the real result because of this short period of estimate. So, and the growth is not exceptionally high. You can imagine if you see here the low margins, we have revenue growth, but for $1 more sales, the company has 3.3 US cent more cash flow or more profits, not necessarily cash flows. And that's not so much. So Costco isn't Microsoft or Amazon. They are not able to increase their earnings so fast. This means if any company in the if any of these companies we are talking today is aggressively overvalued, it takes a lot of years for the stock to catch up with the current stock price. This might be a problem if the stock price comes down. If you buy today, then you will probably have to wait a decent amount of time until the capital gains based on the increasing fair values reach your entry level again. So that's the other side of the medal. And the other stock you just mentioned, Kroger?
Kroger, KR.
Do we have that? Yes.
Yes, you do.
Kroger.
And we actually have a question on Kroger. Let's show that. So can you give a customer view on Kroger and Costco and their business models? So that's an important topic. Kroger is a purely retail grocery store. In fact, the grocery store that we have across the street is a QFC, Quality Food Centers. That is one of the biggest brands in the Pacific Northwest, in the Seattle area where I am. That and Fred Meyer is another one. Back in the 90s, Fred Meyer bought QFC, and then Kroger swept in and bought Fred Meyer to bring them into their umbrella. Quality Food Centers it's pretty decent quality. Actually, it's very high quality. I've always been happy with their stuff. Fred Meyer is a little bit lower priced and more bulk. The important thing about Costco is it started as a wholesaler, and then they moved into membership, where you have to have a membership to be able to enter their stores. Costco sells bulk size, and the American consumers over here really like those bulk size products. You're talking 24 rolls of toilet paper in a single package, or 48 rolls of toilet paper in a single package. And I'm not kidding. Those are the grocery carts that you push around in the Costco stores are bigger than anything anywhere. They wouldn't even fit in a regular grocery store aisle. So that's a little bit about their business model. And they're sourcing from all over the world. So there's a little bit. Now, how about Kroger for valuations and fundamentals?
Let's see. First, maybe regarding fundamentals. Kroger also has nice revenue growth, but they are missing traction starting in 2019. So the business year 2019, revenues were decelerating even, or they were even shrinking a little bit from 122.6 billion US dollar to they lost about 1.5 billion US dollar in revenue. But now they regained it. And regarding margins, they are below Costco. They now have margins of between 2 and 2.5%. So Costco had higher margins, and Costco had also a little bit better revenue growth. And if we look at the valuation, then maybe the stock price is already telling us something, because I just told you that we had a sluggish revenue growth, and the Kroger the stock price reached its peak in 2016, very beginning of 2016, and then there were tremendous capital losses. The stock lost more than half of its value between starting 2016 and 2017, in nearly 2 years. And then there was a recovery, and now in Corona times, again, the stock price dropped. But now there was one more recovery, and the stock price is $34. So someone just posted a comment and saying that all quality stocks are very expensive right now. And maybe we can extend this and say that defensive quality stocks are expensive right now, or defensive stocks, or sure dividend stocks. And I think that Kroger, we can count on this, or we can say that this is a safe dividend stock too. And this might explain also the capital gains from $21 to $33 right now. And the long-term yield starting in 2000, this stock is 7.1%, so well below Costco, but about the average of the general stock market, I'd say. And regarding valuation, just let me look at the multiples so that I'm doing a decent valuation. I would say we start here, and then let's see the outcome. So the reported earnings are a little bit there happened exceptional items, so we get rid of this. So now we have the adjusted earnings, and maybe look at the cash flows, and then you see that we also have some exceptional stream of money flooding the company, obviously. So let's get rid of this. Let's have a look at the fair value dividend. And this one looks good for dividend investors especially. So it seems that Kroger started paying dividends between 2006 and 2007. Let's zoom in a little bit. And then we see that regarding the adjusted earnings, the stock is exactly fairly valued. You see this, Chad? Here,
Yeah.
Where I am. It's an exact match. Regarding dividends, the stock looks cheap. Really, this means that you get more dividend right now than in the historic average. Current dividend yield, I don't know. It's about 2%. We can have a look at it, but the historic average was 1.5%. So if you look at into the dividend turbo, thanks God there are no special dividends right now here, so we can enjoy the dividend turbo without any handicap. And this is the dividend yield. It was already much higher in 2019. The dividend yield was 2.7%.
And
Now
that's because the stock price did such a dip. If you go back and
Exactly.
forth between the stock price and the dividend yield, it's a reverse ratio.
Exactly. There's just someone asking if the live stream will be saved, and yes, you can watch it later as often as you want. It's free. So this is the current dividend yield, and it's lower than some months ago still, but it's on the historic average. It's still higher. So if we change the zone, for example, at this 5-year corridor, then you see that the historic average here, the current dividend yield, is above the average dividend yield. If we add this 10-year, then it's even more clearer. And we did a valuation of the stock here using 10-year plus or more than 10 years. So this is why the valuation says that regarding dividends, Kroger is a buy because it's undervalued. And the analysts say that there will be more dividend increases. I will show you, it's here. So analysts say there are more dividends to come for this stock, which makes the stock even more valuable in time regarding dividends. So to sum up, from a purely fundamental point of view, I would prefer Costco. Costco looks stronger to me, but regarding valuation, Kroger looks to be more attractive. So now up to each investor to decide.
It's also important to mention that the stock price of Kroger is $34.71, while the stock price of Costco was like $325. So there is that. But when you're looking at that kind of thing, you want to look at total return. So let's look at Seeking Alpha total return for these two particular stocks compared with each other. This is a 10-year timeline. And you can see that both price and dividend return of Costco over, since 2017 beat out Kroger handedly, easily.
Exactly. That's what I said. Exactly.
So even if the Costco stock price is 325, if you can get in, or if you could have gotten in 10 years ago, we keep joking about a time machine, as of now, you will have really beaten that out. Now, these are still stocks that I wanted to show. What are some of the consumer discretionary stock or consumer staple stocks and non-discretionary that you wanted to show from the international perspective?
Okay, exactly. International perspective. That's the point, because I knew that you, as an American, that you are so ecocentric that you are only choosing US stocks. And because we have global stocks here, no criticism, just joking. I chose stocks which are located outside the United States. And I made a little watch list. And I think that many people even don't know one of the stocks. Although these stocks are, at least in my point of view, also quality stocks. And okay, let's start. There's one stock from the Netherlands, one from Belgium, neighboring countries located in Western Europe. And then we have one stock coming from Japan. So it's a Japan company. And all three companies have something to do with food. So we have Amsterdam Commodities. And when I was looking first at this stock, it was for me like a successor of the East Indian Company. It's not. It has a low market capitalization, only about 1.6 billion US dollar. So it's not so large. But I will just show you that it's a solid dividend payer, and they pay their current dividend yield is 5.6%. So what Chad just said is true, that you shouldn't be. You shouldn't focus only on the current dividend yield. You should focus on the increase and so on. But anyway, 5.6% is not a bad sign by itself. On the contrary, it makes the stock look attractive first. And what are they doing? I can show you their website maybe, or I'm reading from Wikipedia because I can't tell it better, at least not in English. So what are they doing? They are involved in all the intermediate stage of food transportation, processing, packaging. They store the food. They do analysis. They analyze the food, the nutrition tables and all this kind of stuff. And of course, they distribute it. So they buy the food, they buy the ingredients, they process them, and finally they sell them. not in the retail, but they sell them into to other players of the food industry who themselves sell the products later, and they make money with that. Most obviously, they earn money with this. If we look here at the revenues and margins, then first you see this increase. An increase like that, it's very unlikely that it's an organic increase, but more probable that the company bought another company. And this, the balance sheet, if you look at the balance sheet, then you see that is most probably true. The debt increased from 32 million to 164 million, not billion. So this company is not the largest company in the world. And then we see there's another strong indicator that there was an acquisition of another company. The number of outstanding shares increased from 16 to 23 million. So they raised capital for the acquisition, and that's why the revenues went up 2 years, because most probably the acquisition was done in the running course of the business year 2010, but not all revenues from the acquired companies were already accounted here. And this is why we have 2 years of strong revenue increase. But afterward, this is the organic evolution of the revenues, and you see it's not a strong growth company. It's not a strong growth company, but it's more a stable company, and a reliable company. And then we have the margins, and the margins in the long run, they dropped after the acquisitions. After the acquisition, margins were about 7.1%, and now it's 6.6%. So they dropped a little bit, but overall margins are stable, especially in the last 1 to 2.5 years. Margins didn't change at all. On the other hand, you see here that regarding earnings per share, there's no growth, or there's nearly no growth here in the long run. 2011, 1.15 euro, and now 130, 132. And regarding the estimates, sluggish growth of per share data. But what's interesting is when I looked here, we have these US stocks, and we are already used that the management in the US is doing share buybacks aggressively, so they boost the per share matrix. Here we have the opposite. That means that the number of outstanding shares increased from starting in 2009 till 2017. So we have here, you can see it here, always are not so much. I didn't check this. Between 1 and 2 US cents less growth here on the earnings per share data, because the number of shares has gone up. Okay, but I just wanted to show you this stock, and regarding the current dividend yield, you see here, here it's a still reliable dividend payer. And then you see the dividend yield here, and it's 5.6%. And this is well above. Here we have another phase. It was during the financial crisis. The financial crisis did not really touch this company, but obviously it touched the stock price. So let's have a look here. Did it touch the stock price? Let's go back and logarithming. Yeah, here you see it. The stock price dropped from 5 euro to 3 euro. And then we have this peak probably, but let's get rid of that. Just if you have a look at here, and then you see that the current dividend yield is high for such a stock. And I think if you opt for a slow grower like Amsterdam Commodities, then it's really primordial that you buy the stock while it's attractively valued, because it has really sluggish growth, and you can't expect, or you shouldn't expect, at least a really high overall yield if you invest in such a stock. This is the acquisition phase, and I wouldn't recommend that you start taking or calculating the overall yield starting in 2005. You see that it has an historic yield, which matches Costco. Close to, or at least it comes close to Costco with 16% annual yield. But we also see that most capital gains were achieved in the phase which was close to the acquisition. That's why I would make this valuation of your annual average yield not starting before the acquisition, but after. And then we have an annual yield of still 10.4%, which is still really high. Higher, I think, than it will be for the coming years. So this is one stock I wanted to show you. And then I have two other ones. Next one is Colruyt. And Colruyt is a discounter. So they own a lot of stores. I can show it to you, bring it up to you. So for our German audience, you might know Spar, for example. So they have a lot of brands where they are selling their retail merchandise, but they only sell in Belgium, France, and Luxembourg. So in Francophone countries. And let's have a look at the fundamentals here.
But even just limited to those three countries, their market capitalization is still pretty impressive.
Yeah, most probably because they sell enough stuff. Huh? They have a revenue of 9.6 billion euro, so about 10 billion US dollar.
Wow.
Do you remember about Costco? They are larger. Huh?
I think so. I can bring them up and find out.
And while you are doing, I'm looking at the margins. Margins are steadily declining here, starting from 6% in 2006 to 4% right now. So they lost 50% of operating margins. That's not so nice. And if you look the last years, the revenue, there was a decrease even, and then revenue was flat. So last years weren't very successful for this company, while the per share matrix are still going up. So let's have a look at the number of outstanding shares, and this explains the contradiction between these two charts. And then you see that the number of outstanding shares is decreasing, so management is doing share buybacks. And while the organic revenue growth is either not so impressive, let's have a share repurchase. So for example, here in 2018, they have business year ending in March. And in 2018, for example, they have a unchanged earnings per share, but only because of share buybacks. Okay,
so Costco has a market capitalization right now of about 143 billion, and they reported at the end of their 2019 fiscal year a revenue of 152 billion.
Okay, about 150 times more revenue than this one. Yeah, that's not uncommon if you compare German stocks or European stocks with US stocks, right. Especially if we go to more exotic stocks like these ones. I didn't want to pick a Unilever or something like that because anybody already knows these stocks. Yeah. But we can do, of course, if you like, in a later session. So that's Colruyt, and let's have a look at the dividends. 2.7% dividend yield so far. And then you see dividend yield goes up and down. And right now they are somewhere in the middle, but it's a reliable dividend payer. You can also see it here. And let's have a look at the coverage of the dividends. And then you see that the free cash flow covers the dividends, at least right now. It's also a little bit bumpy. It was close in 2017 and 2018, but right now dividends are covered once again. Regarding the yield, of this stock. Let's have a look. What to expect from this stock? About 10% yield. Not bad by itself. We more than Kroger, for example. And regarding the current valuation of the stock, I start here with the valuation period. And let's have a look. You see that the stock operating cash flow we can't use. This one. The stock looks to be fairly valued. It's interesting. Well, let me have a look here. We have regarding the analysts, there will be a slight dividend decrease, but it's not sure that this is true if we have so exotic companies which are not heavily covered. This means that there are not so many analysts covering the stock, and the update of the estimates is not done so often. Then there might be a little mismatch. And if we have dividend cuts, which are, if you have dividend cuts about 30%, 50%, or even completely, then okay, that's a strong indicator that analysts really think that something goes wrong, and then you just ask Google, and Google will confirm it to you. So,
well, looking at that graph, I would expect, given the drop in free cash flow that the estimates are expecting between now and the end of next year, a dividend drop that small compared to that free cash flow drop is something that I would accept as an investor, saying that's fine, because it'll, as the economy comes back up again, we'll get back up to speed, and then we'll see increases again.
What you say sounds logical. It's okay, and it could be, but I already have a lot of experience collected with different data providers, and I know these edge cases where dividends decrease by low percentages, and management, it's very improbable that management is going first to cut dividends for very slight sums. Many managers are not going to do this because they know that their investors won't like that. That's first. Second, if you look at the stock here, then you see that management in 2017 or 2018, where the free cash flow was closely matched the dividend payments, also did not cut the dividends, but contrary, they still increased dividends.
Yeah,
so
that's a good
if the management did not change its mind or was completely replaced because of sluggish revenue growth, they will do the same. They still think the same way. And I know that exotic stocks with low coverage, if we have sluggish dividend decrease, it's mostly artificial. I don't take this serious. That's from my experience. And if I'm not certain, okay, I'll have to Google, or I will have to ask investor relations for it. If there's a press release or something else. Right now, it's always a good idea to look into the investor relations, because any CEO or any management is going to say something about the effects of revenue of Corona regarding their business. Any management is saying something. It doesn't matter if they profit from Corona or, on the contrary, if they suffer from Corona. Everyone is saying something. If they only say, we don't know what will happen and we won't give any outlook anymore. Okay, this is the slow dividend decrease here. I don't take it serious. So the current dividend yield is 2.7, and I also see that there will be a dividend increase in the over next business year regarding the analysts. So, but this stock, we wanted to look at the valuation, I think. Yeah, here we are. So the stock is slowly or slightly undervalued right now regarding the fair values, but regarding the current business year, the estimates, the stock is fairly valued. Regarding the help me regarding the earnings both adjusted and reported. So the stock looks to be fairly valued. And what I don't like about this stock is the estimates are not very optimistic about this stock. So it's just running. It's
running flat.
Sideways. Yes.
Yeah, sideways is a good way of putting it.
Not much fantasy. So I don't think that the historic yields can continue with this stock. But I wanted to show.
Again, we can only look out as far as the estimate data is there, and that only goes to the end of 2022 in a lot of cases. So,
Exactly.
That's all the estimates, especially with the Corona scare being so out of control. Nobody knows where business is going to go. Nobody knows what, whether the customers are going to be there or et cetera, et cetera. Everyone's battening down the hatches. So it's better to see something like this where it's going sideways than a pessimistic view where they think it's going to crash. This would not be a buy for me right now because I want to see estimates that show that we'll be making money both in capital gains and in dividends. But at the same time, if you have this stock, this would not be a time to sell.
Yeah, exactly. It's a stock you can keep. But I agree with you that there's not so much fantasy with the stock. I wanted to show it to you anyway. Maybe I should have shown another stock, but I opted for Colruyt. But now let's go on to Japan. And this is the last one. And this is a beer maker. So I think for many of the viewers, it makes a company attractive by itself. So they produce beer like sake and these things. They sell most things. They sell most of their beverages they sell in Japan itself. They also have a little segment of pharmaceutics, but they only do about 50%, if I remember, with pharmaceutics. So, and they are a company. They belong to Mitsubishi. This Kirin Holdings belongs to Mitsubishi.
Okay.
And if we look at the fundamentals, then we see that the earnings are a little bit. So we have here. I looked what happened in 2015. So they posted a loss in 2015. But that was an impairment charge. There happened something with their in Brazil, and they had to write off their shares in Brazil. And if we look at the adjusted earnings, then we see that the things look a little bit better. So we have adjusted earnings starting in 2005, and there they did not post a loss. They also it also decelerated, or it was a bad year also regarding the adjusted earnings, but at least they did not post a loss. And you see that the adjusted earnings are much smoother than the reported earnings. But what's also important for sure is that we still have a solid dividend payer here, a solid dividend paying companies. They did not decrease or cut their dividends for 30 years already. So this is a solid dividend paying company. And right now, things look better than they did before from earnings perspective, at least. If we look at the revenues, then okay, I mostly agree with what you might think. That here we don't have much growth to say it a little bit defensively, or we have even decelerating growth, decreasing revenues. But at least at the margin side, we have better margins. So we have higher margins than before, with about 9% right now. And they pay dividends of 3% at least. They have a market capitalization of 60.5 billion US dollar. So it's the largest of the three companies here. And if we take a look at the valuation right now, so I think this stock might be a little bit harder to evaluate because of these ups and downs of
the fluctuations make it difficult.
Sorry?
The fluctuations make it difficult.
Yeah, exactly. The fluctuations make it difficult. Thank you, Chad. So let's try it anyway, starting from here. And then we have the stock price here. And what you always did was what's the annual return in the long run? So it's just 5%, so it's not so much. 1/3 of the overall yield is coming from dividends and the rest from capital gains. And you see that the stock price dropped from 3,124 yen, Japanese yen, to right now 2,100 Japanese yen. So that's about 30% exactly capital losses within 15 months. Okay, let's have a look at the valuation. You see here.
Wow.
That's clear. You can't use this one. You can try these ones. That means, and the fair value dividend, of course. This will be the best one. I'm already really sure. But if we use here the adjusted earnings, fair value of the adjusted earnings, then we see, let's zoom in a little bit, that the stock looks to be fairly valued right now.
Let's just put that number into context. What is it right now? 2,000?
To 2017 yen.
Okay. For everybody's information, the ADR on Seeking Alpha says that is $19.36.
You be careful, because very often it's not 1-to-1. So one ADR doesn't necessarily represent one stock, one Japanese original stock. So you'll have to look at the ratio to.
I'm looking for it.
Or just do a currency conversion and calculating how much dollars 2,085 Japanese yen are worth, or 2,070. So what's interesting here is the stock looks to be fairly valued right now regarding the estimates. So it's exactly fairly valued regarding the adjusted earnings. And now comes the interesting part. What about the fair value dividend? And then you see that the stock looks crazily undervalued. So because of this drop in the stock price, what I show you here, because of the stock and drop price and the increasing dividends, so the stock price dropped, the dividends increased, and this makes the overall dividend yield right now fairly attractive. And you will also see it here. If you look into the dividend turbo, then we see here that we have a solid dividend payer. If you look here at the blue columns, and you see all the increases of the dividends. So it's a really reliable dividend stock. And then you see that if you bought the stock in the past, then you bought it with a dividend yield of, depending on when you bought it, below 1%. So here's 0.8% dividend yield, and now we get 3.9. Oh, that's it. Oh yeah, 3.1% dividend yield, so above 3%, and that's very high. That's higher than any time before. So that's a record dividend yield for Kirin Holdings. But we see that it's a little bit the same as for the other stocks, and especially Colruyt. You shouldn't expect too much from such a stock. So I think that for Chad, none of these stocks is a strict buy. Do you agree?
Yes, I agree.
So yeah, I will have to look for another other stocks for the coming live stream to satisfy you, to convince you to invest in Europe or in Asia.
Well, there's a lot of stocks out there that I would be delighted and interesting. Like we said in the preview last week, the top one on my list overall is Tencent, and it's just one of the ADRs.
It's not the uncyclical consumer discretionary Tencent, We talked about it in the last live stream. So if you are interested in Tencent, then just have a look at this one. There's also a comment of someone, and he says that the three stocks I just presented are not quality companies. So I don't agree. They are quality companies. They are not growing fast, but they still have quality. They are reliable dividend payers, and they are not zigzagging regarding margins and revenues. So there's still some quality in these companies. Otherwise, I hadn't chosen them. But okay, they are not the companies most people want to invest in if they expect high long-term revenues. He says Unilever, for example. I also mentioned Unilever. I wanted to show you some companies you don't already know. And then he also mentioned Puma or Adidas. But like Tencent, Puma and Adidas are not the stocks we are interested in just right now in this live session.
But we'll get to them. We're doing these sessions once a week, and there are thousands of stocks. I will say that I didn't know about any of those. So that's the whole point of this. Not everyone in the European market might know Costco or might know Kroger, but one of the things that I wanted to mention is I've been looking in Wikipedia and a couple other sources, and the drop in value in Kroger that we saw was in all likelihood due to the number of acquisitions they've made over the last decade. They are growing like crazy, and that cuts into their margins. It cuts into their profit margins. But once they get all of that settled, then we'll see the profits come.
Exactly.
So
I have an interesting question here. And there's someone asking what we will cover next week. And it's not 100% decided yet, because we listen to you, what you want. So you can post your propositions, what you want to see and hear here next week in any of our channels. We will pick it up. We will read it. And otherwise, Chad and I, we already thought that looking at some technology stocks might be interesting. Maybe, Chad, was it hardware or software companies? You mentioned a software company with Tencent, but do you prefer something, hardware or software companies? I don't want to mix.
I don't know. We'll talk about it. We'll see what the comments are. We can certainly go back to information technology. Let me talk a little bit about what I'm doing on my Total Growth Investing channel. I posted a video yesterday on global payments. Let me share my screen. There we go. So this is my channel, and this is the latest video that I put up on Global Payments Incorporated, GPN. 62 views in less than 24 hours. That's awesome.
Okay. It's kind of Wirecard, online payment.
Yes. They're not Visa, MasterCard. They're not Discover. They are a network, and actually they were one of the first market-based companies. They were one of the first companies to come out in the markets that provided infrastructure for all of these credit cards, for both Visa and MasterCard. And then in the 90s, they started processing Discover transactions. In the 2000s, they started processing China Union Pay. They are a global connection. We'll provide the link to my channel so you can watch it. I've also gotten a lot of questions recently about energy companies. Okay. So I'm doing a little research on the energy sector, mostly oil, crude oil, gas, midstreamers, that sort of thing. And that's the next video that I'm working on. What videos are you working on with your team? Because I know you have a whole team of people.
Yeah, exactly. So can I share the screen?
Of course.
Okay. Then just, so you probably know that we have a German and an English side. I show you the English side right now. We have a blog here, and we post about 2 up to even 4 stock analyses each week. Right now, we are 5 people, and we are all authors from Seeking Alpha, me included. Although I didn't publish for some months already because of lack of time. But here you see that on our blog we publish stock analysis of really different stocks. Facebook's the last one, and BASF. Probably even you as an American, you know BASF. And
Yep.
then we have VP Carry here. It's a REIT. Then Deutsche Telekom, Nike, Realty Income, and we have Salesforce, another tech stock. So Amazon, of course, you know this guy most probably. So a lot of analysis, and for some of them, I also do videos on my different YouTube channels if I have time and I'm in the right mood. So just look at the blog, and they will find it. And anything is free, so there's no payment wall or something in between. Yeah.
Cool. All right.
Okay. Then I would say, Chad, some last words to the nice community.
I started my streams on Facebook because I saw a whole bunch of people joining the group and talking about this or that high dividend, high risk stock, wondering if it's a good deal. And I've been there. I've done that. I started this channel to try to prevent people from making the same mistakes because I lost a lot of money buying high yield stocks that were collapsing in value, and that I don't want other people to lose money. The first rule of investing is don't lose money. It's not get rich. It's not, buy low, sell high. It's don't lose. So
Okay.
that's where the research comes in. That's where tools like Dividend Stock, Stock Cash comes in. That's where ranking lists like my TGI list come in, things like that. I do want to have one quick note. I saw a comment where somebody was, let me see if I can find it, comparing me with one of the professionals. I am not a professional. I am just a guy who knows how to use a YouTube channel and a Facebook. And I don't want people to get the wrong impression. I'm doing this because I don't want people to make the same mistakes that I did. There we go. So my list is probably not better than David Fish. It's different. It's using different metrics. It's using a different goal. My goal is as high a growth as I can find. If you go to Seeking Alpha and you look at some of the authors, they use all kinds of metrics on their lists and their ranking scores. I use 3 because I'm still getting familiar with everything. I think I'm going to do well. I hope I'm going to do well. But what I'm trying to provide is not the end all and be all of what stocks people should buy, but an example of how you can build a ranking list, build a portfolio growth strategy, and then you come up with your own.
Exactly. And what we are doing here on the stream is we are doing a combination. So you are showing your list, and then we extend this. We extend the outcome of your list and have a look maybe a little bit deeper in the fundamental analysis using our screener. And by doing so, we discover some new things. We discover some new stocks. We talk about general topics. Even if I right now presented 3 stocks, which might not be the most interesting to many, we still were doing the fundamental analysis, which is valid for any stock. We'll have to look at. And I think this is more valuable than getting some pieces of advice of buying this or buying that stock, because you are responsible for your money. And if you get a bad advice, you won't get the money back from this person who gave you that advice.
Right. And one of the things that I noticed when I was building my total growth investing ranking list is stocks were popping to the top that I had never heard of. if you look at that list, how many people here knew Johnson Outdoors was a multi-billion-dollar company that is one of the best stocks for growth that's out there? Well, I did a video review on that. This, you know, I don't
We are
think
always
this is
going
right.
to validate your high performers on Dividend Stocks Cash and see if this holds true. Huh?
That's
some
actually just for
challenging.
GPN. But another one was ASML Holdings. You know, it's a semiconductor company. I didn't know it existed until the numbers popped it to the top. Market Access Holdings, I didn't know it existed until the numbers popped it to the top, and then I looked harder at it. S&P Global, I didn't know they were a public company. I thought they were just an index, company. Things like that. So when you're building a watch list, you're going to see surprises, and that's when you look deeper. And both Torsten and I are here to help people learn and to learn ourselves how to look deeper into the valuations of stocks, how to look deeper into the fundamentals, and determine whether they are good investments or not. And we're going to do the best we can.
Okay. So on my part, I'm finished for this time. Coming again next time on Sunday, probably.
Yes.
Same time, 20 o'clock. We will make the announcement on all of our channels. Then thanks for watching. Was more 1 hour and 20 minutes, like a short blockbuster on Hollywood already, but not that expensive.
And we've had 106 people view, or we have 106 people watching right now. That's amazing.
On summer.
I really appreciate everybody watching, and
Okay.
Have a good week. Have a good week in the markets. Stay safe. Wear your mask outside. Anywhere in the world, wherever you are. This thing is not going to go away soon, and we don't want anybody sick.
Okay. Bye-bye.
We'll see you next week.